Who doesn't like Tevia from Fiddler on the Roof? And with us today is another gentleman out of Russia originally, Vitaliy Katsenelson. He's the author of The Little Book of Sideways Markets. And Vitaliy, you're an advisor in Denver. What about Tevia could you possibly bring into your book about value investing?
No, the stock market is very volatile. Okay, if you look at the prices all day long, it kind of turns into a trader. I'm not a trader, I'm an investor. So in the book, I try to put my readers into the shoes of an investor. And I use an example of Tevia, the milkman. He's trying to buy a cow. So he goes to the stock auction, where they sell cows, and he wants to buy a cow. So, but he needs to know how much it's worth. So he figures, okay, over the next 5 years, the cow is going to give him milk. It's going to give him baby cows. He's going to get cash flows out of that, every single year for the next 5 years. Then at the end, he's going to sell his cow to the petting zoo or to the butcher, most likely to the petting zoo because he's a very kind man. So that helps. Now that Tevia knows the cow, how much cash flows cow will generate, he knows what the cow is worth. So he can take this cash flow discount, and that gives him the value of the cow. But if you could buy it, if he could buy this cow at this price, why bother? So he needs to buy the cow with a margin of safety. And that's when, so in other words, if the cow is worth $10,000, he wants to buy it maybe for $5,000 or $6,000. Okay, so this difference is a margin of safety. So that's what investing is all about. You basically look for companies that you can understand. You figure out how much they're worth, figure out how much discount you need to the fair value. That gives you a buy price. When companies get to this buy price, you buy them. Otherwise, you just wait.
So what is it about sideways markets that you invest differently than you do in a regular uptrending or a bearish market?
So in my book, I talk about secular, which means long-term sideways markets. So what happened over the last 100 years? Every time you had a protracted bull market that lasted for a long period of time, stocks got expensive. During the sideways market, and then sideways market started, and during the sideways market, valuations declined little by little, and earnings grown. So those two forces kind of work against each other. That's why you have a lot of volatility, what we saw over the last 10 years, but stocks really don't go anywhere.
So it's kind of hard to figure earnings in those periods, and it's kind of hard to figure what an appropriate multiple is, right?
Exactly. And today's economy makes it more difficult when it comes to earnings because, we had basically the Federal Reserve, was creating a lot of bubbles. Okay, so which makes things more difficult. So that's why when I look at companies today, I try to stay away from very cyclical companies because it's very difficult to figure out what the earnings power is of the stock.
So like a Union Pacific, something like that, they're doing great now, but they're tied to commodities, and that's tied to the bubble, and that's not sustainable.
Exactly. So that's why I would stay away from this kind of stocks. Yes.
Okay. So what are you looking at? What something stable? Some kind of a healthcare?
So yes, I mean there are a lot of opportunities in healthcare. Two stocks that I like. One of them is a double defensive stock because it's actually it's a non-cyclical company, and it's in the defense industry. So which is L3.
Right.
So that company is a $70-something stock, has earnings power of $8 to $9 a share, strong balance sheet, good management, buying back stock. So that's a very
defense contracting, not a bad idea.
That's right. Another one is it's a healthcare company, Medtronic. This is actually an incredible company because over the last 10 years grew earnings and revenues about 14% a year, which I think is incredible. Trading about 9-10 times earnings. So this is the company that can basically pay off its debt from its cash flow within a year, has a very good product pipeline, and its earnings power is there. In other words, no matter what the economy is doing, this company is still going to be able to make what it's making today or more.
You can milk that cow.
That's
All right. More ideas? Check out Vitaliy's book, The Little Book of Sideways Markets. Thanks, Vitaliy.
Thank you.